Hi, this is Lauren with Verivest, and we are chatting today with Vince from Equity Group Investors. Welcome. We're super excited to chat with you today.
Thank you. I am as well.
So let's just hop right in. I'd love to hear how you ended up where you are today, how you ended up in real estate, and a little bit about your firm's origin story.
So it actually starts like a little before me. This stuff, I guess you could kind of say, is like in my DNA. My great grandpa, he bought his first piece of land in the Bay Area in 1906 in Sunnyvale, which is the same Sunnyvale where Apple is, and there's like 120 acres. And then it went on to my grandpa, who bought more land, developed medical office, developed some apartments. My dad then also, developed a single family. He had some rentals that I used to go paint when I was young, like after tenants would move out. And so this stuff was kind of like dripped into my head, like through being young. And that's why I kind of feel like it's what I'm supposed to be doing. And I love this business, and anybody on Verivest and Philly, it's a great platform. I'd love them to reach out and speak with me. So the next thing is like I kind of, I went into sports, and I was like a walk-on to scholarship athlete, team captain, and all that good stuff. But, I always knew I wanted to do something in real estate. So when that kind of finished up, I moved to San Diego and started in the mortgage industry. And I like to talk about it in like lessons learned, you know what I mean, over the course of my career. That was right before 2008. And I was sitting there doing these loans with like a 2-year fixed and a 3-year prepay, option arms where you're adding back to your principal balance. And I kind of got a lesson in risky debt there. And I actually didn't feel like it was the right thing to be giving people. So I left the industry. I left and went to bartending. And, at the time I thought it was one of the worst decisions of my life. My friends were still doing well in that industry. And, I later on, I was like, I feel like I dodged a bullet a little bit. But in the bartending, I actually met a guy who worked at Marcus & Millichap. I know Lance always talks about how there's lots of alums, the Marcus & Millichap alums that are doing this type of fund.
Right.
And it's probably due to it's a really good place to learn the business. And anyways, I went to work there, and I saw a lot about how to move across asset types, move across the A to B to C market, the way different leases and debt structures affect people in up and down markets. And, but at the end of there, I kind of looked around, and maybe because it was right after 2008, it seemed like people, maybe lost some of their properties or something, or I didn't know what it was, but I wanted to own, and I wanted to build something in this. It's probably due to this being in my DNA and kind of my whole family, like going back to my great grandpa being entrepreneurs. Yeah. And so I left and I went into private equity, and that was a really amazing learning experience. I'm super happy I got to see that industry and work in it. There's something going on looking at banks' balance sheets called FDIC loss share. And extend and pretend, which aren't unlike COVID forbearance and holding them off balance sheet and shadow inventory and all that type of stuff, which we might get into later. And, there's a lot about how to like structure deals. And then we were taking arbitrage on, single tenant net lease companies that had been downgraded from credit tenant or credit, investment credit to junk credit. Mm-hmm. And life insurance companies can't hold that on their books, so we were buying them from the life companies at like 90 cents, selling them to the banks at like 95, and taking a little bit of arbitrage on like large portfolios. I'm not sure if I can share the names of the people. There's a lot of NDAs and things in that business, but one of the biggest private equity players in the market came to us during that time, and they're like, we want all your land. And nobody wanted land at that time. It was right after the crash. Nobody was developing. And then, it was selling at like 5 to 10 cents on the dollar, and they bought it up in huge amounts. And so, when looking back over like a full cycle, and this is something that when I spoke to Lance that he loved, is that I had all these different experiences, so you kind of can get an idea of where to sit in the market to get deal flow, especially with going towards like a fund structure like we're going to now. That company eventually changed directions. I went to work for a single-family developer and a fix and flip company, and that's where everything kind of like gelled. Like all these different experiences kind of came together, and I did really well in that company. A lot of sales records and things like that. Eventually the growth kind of seemed like it kind of stagnated, and I felt like I had enough experience to go do this stuff on my own, and that's when I started my company. And then the rest of it, there's a story to how it kind of grew to where it is now.
Yeah, absolutely. That's great. I love how diverse your background is. I mean, I'm sure it's added so much to the success of your firm now.
Yeah, absolutely. And even my dad, when I was going through all this stuff, even my dad, he's like, Vince, what you're learning now will serve you for the rest of your career. And now I think I tell him he's right like once a month.
Right. It's true. It's really true. So next, I'd really like to hear kind of who the key players involved are that allow you to execute your acquisition and asset management strategy.
So this is something that I'm most excited about. If I was it's kind of been a roller coaster of when they're going to come on board and how they are, and I wanted to deal with a specific team, and the reason why is you can go to a lot of places and find people with huge track records, and I think anybody who's probably going towards a structure like this, they have that track record, and these people definitely do. They work for one of the guys worked for several $billion fund coming in and fixing their teams, or another lady worked for a startup fund that went from like a couple million to several hundred million, and another lady had her own startup and grew it, sold it, and then went into basically asset management. The other guy kind of syndicated debt. All these things are kind of like high level, high stress, like kind of growth type companies, and when starting out something like this, you want those type of players that can thrive in that kind of environment. But these people are also like people I had heard about in the industry, or friends I made over time. And the thing that really gravitated me towards them is that they had a diverse experience, and they had good values, which I know from going to Verivest things. That's something that is up and down, fairway, Verivest, all that stuff. And we can get into that later. That's how I came to you guys too. But the diversity of thought and experience, there's like, you can pick things out there in the market. Like long-term capital management is a very good indication of this. They have the highest pedigrees, like 15 PhDs, and some of them wrote the formulas of how like options trade, and they were options traders, and they were sitting on that board, and they failed in spectacular fashion. And one of the guys said, we should have fired two of the people and hired a secretary and a gardener to be on our board, so we had diversity of thought. Right. And so I'm saying all that to say that each person in my partnership makes the whole better, and I feel like that's the biggest thing to how we can execute on our acquisition strategy and thrive in these coming markets.
Yeah, absolutely. Yeah, I totally agree with your thought process on that. That's a great way to build a team for sure.
Well, that's how I found Verivest too. Right. I read the book Capital Attraction, mm-hmm. and I looked at it and I was like, these guys have amazing values. I want to see if this is legitimate. And then I called a few of them, and they walk the walk, they talk the talk. even, they're not afraid to share their ups and downs. And, I asked them a few key questions, like, if in 2008, was there a different fund structure you could have had that would have protected you a little bit more, which I think is important, in my fund strategy as well. And they've assisted me with that.
Yeah.
So I found out that they were walking the walk. They were legitimate about it. I've been to one of their events, and it's up and down from the people they work with to the people in the company.
Yeah, absolutely. And lastly, I'd love to hear kind of what your investment philosophy and risk mitigation strategy is. How do you ensure that you're going to get a return of or on capital?
So this is something where I differ, and I'm kind of view myself as a risk manager within the real estate space. And I'm going to say something controversial here, but hear me out, and then it'll make sense.
Okay.
So you can look around and you hear, everybody talking about how COVID was a black swan, right? And then you can go over to Nassim Taleb, who actually coined the term black swan and wrote the book Black Swan, and he says it wasn't a black swan. And the reason is he's going to talk cryptically about it. He's going to say it falls within a normal distribution of statistical outcomes or something like that. And I'll, translate that. What he's a student of somebody called Mandelbrot. Mm-hmm. And Mandelbrot, his whole thing was that most people run their market prediction off of calculus, and he runs it off fractals. And, say like COVID, prior to COVID, there was a lot of, say Mandelbrot sets or similar sets of things that were all lining up. They were going to show this huge sell-off. It could be like the 10-year treasury, the dollar, the CRB index. And they were all showing that it was going to sell off. And so then you can overlay that with, if you're measuring and mapping these things with growth, inflation, policy, which is a macro term, institutional macro term, which is what I actually use. You can see that the growth, inflation, and policy changes were all slowing in the market. And so if you take that from, you can kind of see how you're not predicting COVID, you're predicting some big move in the market, and that's where Taleb's a little cryptic, and sometimes so is Mandelbrot. I don't know that many people who study Mandelbrot within the real estate space, although I was reading a pension fund's prospectus on how they do their portfolio, and they're talking about stochastics and things like that, and those are kind of terms within that space. And so, how does it correlate over to today, what's going on today? I mean, in my market, the Fed came in and they bought down the MBS market, and they created something called the one-factor model on the upside. It basically just means when the rates move like 2 standard deviations down, that's all that matters within the affordability of the affordability index on residential and apartments and things. And so that's why we're seeing these great increases in price that we haven't seen since 2007. Is that they pushed everybody, because people buy payments, they pushed the rates down so much, the payment went so low that it supercharged this growth. So in the affordability index, there's payment, the home price, and income. And now we pushed everybody up the curve to higher prices. We had this huge price increase. So now it's going to take a less of a interest rate change to create something that's going to slow the market. And if you have a macro overlay on your real estate, you can see these things. The last time we had this happen was 2018, and there was a lot of people, in my markets at least, that got their funds kind of blown up, and it actually created some of the opportunity that I have today watching these things. And so, the other thing is I pair the
the macro with the micro, as we were talking about with Marcus Millichap about how people move A to B to C markets. They usually start in the A market, get priced out, go to the B, then go to the C. And now we're seeing the policy changes on the macro that supercharge the micro changes. Now they can work remote. Instead of going to the C market, now they're going to another state where they can get lower taxes, even lower prices, a better use of their capital. They can have lower payments. It's a different life. And so these things, you can kind of see what's going on in the financial market, and then you can kind of see what goes on in human behavior, and then you can see where you want to sit within the market to, get the most amount of deals and get the best return on capital. And the macro stuff goes even a step further from that. If you're watching these things and mapping it across the market, when the dollar devalues, you can watch, lumber prices go up, copper prices, lumber prices went 3.5 times, copper prices went 2. And then you can go over to see like Lennar, Pulte, all the biggest home builders, and they're all saying, oh, we're slowing on starts and permits because unit costs went up $24,000 per unit. And, then there's the one factor model. They're saying, hey, we're losing buyers because of interest rates. So having this overlay like that, you can kind of see where the market's moving. Mm-hmm. And the last piece to this is, my market is different than, so like I know like Fairway's huge and they buy these, big deals, and there's two different problems within those two type of funds, like my fund and their type. On the institutional side, it's like, can you get the return on your capital, outlaying like $50 million into one deal and then buying, 4 of those or something, because you're competing against all the other capital at the top of the market. My market, you're buying smaller deals that have amazing returns, and it's, can you outlay enough capital into the market to warrant having a fund like this? And that's why, when we talked about the team, I was saying I'm most excited about that. If somebody reaches out to me and I can tell more about the team, like everybody has, operated at that level. So I think it's kind of bringing an institutional style knowledge to a mom and pop industry. And it helps that like Invitation Homes kind of proved the model previously. And so you just have to have the right team, the right kind of way to map the market, and you can thrive in this environment.
Yeah, I can only imagine what COVID in 2020 has done to this market and how it's kind of flipped everything upside down. But it's really great to kind of hear your idea or thoughts on it and kind of hear the background of it a little bit more.
And I mean, even with the COVID stuff, like, when I was talking about like the affordability, these things are acting kind of funny, and you have to kind of dig into detail to see what's going on. For instance, they call it the K-shaped recovery. I know Lance liked one of my articles on LinkedIn. I wrote about the K-shaped recovery right at the start of COVID, but nobody was calling it then. I just kind of like laid out how it was going to go down, and then now they're calling it the K-shaped recovery. So we've had an increase in income, but if it's a K-shape, it's more so because the bottom part of the income fell off. So now if you're doing an average over that whole piece, the income's gone up, but it hasn't really. So that's like what you're saying, how much it's like shaking up the market, or what we were talking about previously with shadow inventory. Everybody, because of that inflation in building supply, like the dollar devaluing, all the wood and copper prices and all that stuff that go into building a house or an apartment complex, because of all that, it inflated it, and the only way for the builders to make margin was build the high end. So through this market, and I actually at the Fairway conference talked to a guy who sells land to some of these large home builders, and I was like, is this happening all over the country? I see it in my market, and he said yes, and there's like 6 months of inventory above $1 million. That's like luxury in San Diego, and that's a buyer's market, right? And then on the bottom there's 1.8 months of inventory, And now with the COVID forbearance and the shadow inventory, they made the lower end of the market even smaller by taking 4 million homes out of the market, which is 5% of the entire U.S. And it kind of, along with the skewing of the MBS market by them buying those down, it kind of pushed the whole curve of pricing up. So like you're saying, it's crazy how the changes in behavior and how the metrics changed with COVID. It's kind of shaking it up a lot.
Yeah, absolutely. Just reading about it is, fascinating. But thank you so much for chatting with us today. It was really, really great to hear more about Equity Group Investors and to hear about your background story. And we look forward to working together.
Yeah, I appreciate it too. And as I said in this, I love your whole group, and I've had many conversations with Lance. He's an amazing guy, and each person I meet within your company is just top notch.
Yeah. Well, thank you.